This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal, and then go to my weekly chat with Matt Hendricks, who is Senior Vice President of National Sales at Sprott Asset Management. After the break, we go to Catherine Murray at our affiliate BNN, who interviews Peter Costa, who's president at Empire Executions. Then to the news, and when we come back, our affiliate BNN interviews Ralph Silva, who is an independent analyst at Silver Research Network, and he takes a look at Canadian bank earnings. Then to Rob Lister, founder of RateSpy.com, who looks at the current mortgage rate environment as the spring selling season approaches. After the final break, we conclude with Thomas Zitsoras, who is Vice President and Head of Fixed Income Research at Strategas, and he joins our affiliate BNN and breaks down the Federal Reserve Board's minutes. But first, let's go to Dave Sally at the Ottawa Business Journal for an update on the Ottawa news. As always, it's great to be joined by Dave Sally of the Ottawa Business Journal. How are you, Dave?
I'm not too bad, John. How are you?
Oh, I'm okay. Don't like the warm weather. Want to get back on the slopes, but we still have some spring skiing ahead.
Oh, yeah, there will still be plenty of time for that, I think.
Now, Dave, the tech sector made headlines once again this past week with one of Ottawa's largest publicly traded companies announcing it was being acquired by a U.S. competitor. Meanwhile, on the real estate front, one of the country's leading brokerage firms says the total value of investments in the capital hit a 3-year high in 2016.
That's right, John. Well, let's start with big news from Halogen Software. The Ottawa-based producer of HR Software as a Service solutions said Thursday it is being sold to California-based Saba Software for $293 million Canadian. The announcement comes just over a month after Halogen, which employs more than 400 people in Ottawa, said it was forming a special committee to explore ways of maximizing shareholder value. At the time, the firm said it was exploring strategic alternatives in response to what it called significant interest among prospective suitors looking to purchase the 21-year-old company. Now, Saba Software is headquartered in Redwood Shores, California, and it sells talent management software, which is the same space that Halogen operates in. The combined firm will serve more than 4,000 customers around the world. That sale price works out to $12.50 a share. That's in the lower half of predictions made in January by many analysts who suggested Halogen was worth between $11 and $15 a share. Halogen board member Rob Ashe chaired the special committee, and he said teaming up with Saba strengthens and accelerates Halogen's future growth prospects. Under the deal, Halogen co-founder and its largest shareholder, Michael Slaunwhite, will become the new chairman of the combined company. Now, the deal is not quite official yet. It still has to be approved by 2/3 of Halogen shareholders and by a simple majority of votes from shareholders other than Mr. Slaunwhite and related parties. And meanwhile, in related news, Halogen also announced its fiscal 2016 fourth quarter and year-end results on Thursday. The company said its total revenues had increased 9% in the fourth quarter from a year earlier to $18.7 million. Total revenues for fiscal 2016 as a whole rose 10% to $72.3 million. Halogen reported a total net income of $1.2 million for 2016. That's 5 cents per diluted share. That's compared to a net loss of $13.5 million in fiscal 2015.
Meanwhile, things seem to be showing a few signs of recovery in the city's commercial real estate scene.
Yes, John, that's right. Brokerage firm CBRE said this past week the total number of investments in the city's commercial real estate market hit $1.49 billion in 2016, thanks largely to a handful of big deals that closed early in the year. Now, that's a 24% increase over 2015 and a 3-year high. The firm noted that in its year-in-review report on Ottawa's investment market. The CBRE said the capital's investment market still lags behind other major Canadian cities. The company said it was a light year for both office and industrial transactions, with relatively few properties changing hands in either class. By contrast, CBRE said multi-residential properties were the most sought-after asset class. They accounted for nearly half the value of all commercial transactions in 2016 at $680 million. Looking ahead, CBRE said it is optimistic about the prospects in the commercial real estate scene, both locally and nationally, with both international and domestic investors seeing Canada as one of the world's safest markets. Major local transactions in 2016 included Minto selling a suburban multi-residential portfolio to CapREIT Apartments for $180.25 million, the sale of the Marriott Hotel to Invest REIT for $111 million, and Chartwell Retirement Residences deal to buy the Lord Lansdowne Retirement Residence for $68.35 million.
And Dave, what's coming up on the OBJ's radar?
Well, John, as you know, Ottawa is a hotbed for startups. Unfortunately, many of them struggle to scale up into sustainable companies. Well, this coming Thursday, the Waterloo-based Lazarides Institute Scale-Up program is bringing business growth expert Kirk Dando to Ottawa for a presentation on the what, why, and how of scaling a company. He'll provide key tactics that businesses need in order to grow, as well as explain the 12 warning signs that a high-growth company may be close to stalling. The event takes place this Thursday at the Canadian Museum of Nature at 5:30 p.m.
Well, thanks so much. That's really a great update, and we'll look forward to talking to you again next week on Sunday at 2 p.m.
Thanks, John.
Now to my weekly chat with Matt Hendricks at Sprott Asset Management. It's great to be joined by Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. How are you doing, Matt?
Very well, John. How are you today?
I'm okay, just trying to figure out where these markets are going. There's so many potential black swans out there that one has to be defensive, and I know that everybody is thrilled with the idea of lower taxes and military build-up and infrastructure, and there's a tremendous momentum in the stock markets. But I'd like to focus on a good defense, and I'd like to emphasize the fact that the Sprott strategies are active strategies rather than passive or indexed. And I wonder if you could elaborate on that.
Well, for sure, John. We definitely perceive ourselves as an active management shop. And again, active management simply means our guys are out there trying to beat the index. And if you're buying an index, basically you're just trying to be average. And you go up in the good times and you go down in the bad times. And good active management can certainly make money in the good times, but more importantly, when the bad times come, vis-a-vis 2008, 2011, you've got guys that hopefully, if they know what they're doing, will be able to protect your money and prevent these massive drawdowns, the minus 10, the minus 20s, which is the biggest detractor to long-term savings and compounded growth.
Now, in the case of sports, we don't like average, and in investing, you need diversification. That's mandatory. And I'd like you to describe the various strategies that make up a defensive portfolio.
Well, certainly, an average portfolio's got an allocation to, let's call it, North American stocks, maybe dividend payers, global sleeve, fixed income, energy, materials. And so you can build up a portfolio of passive sleeves like that. But again, if that certain sector turns south, then you're just going to ride the wave all the way down. So you want to have a manager that certainly is, again, good at what they do in the good times, but have the ability, like our guys do at Sprott, to go to cash, to actually short the market that they're in, and possibly use derivatives as insurance to protect from, again, these drawdowns. And with markets at all-time highs here, I mean, they certainly can go higher, of course, but there's more downside built in, I would say, than upside. And you obviously want to have money in the markets in case things do keep going, but you need to have a manager that's got the ability to be nimble, fast, and protect you if things go sideways in a hurry.
And certainly in the fixed income market, Scott Colborne's strategy is really one of the most important ones for people who are threatened by a rising interest rate environment, and the fact that when interest rates go up, then long-term bonds go down.
Well, for sure, John. The fixed income is the biggest problem with every financial advisor, and I would say every end client out there, especially the ones that are over the age of 50 that are looking for safety. and, don't have the stomach of being in a overpriced stock market to try to get dividends. Scott Colborn has got a global unconstrained mandate, meaning he can go anywhere in the world he wants to find yields. He can go short. He can use derivatives to enhance his offense or his defense. Compared to the average bond fund out there in Canada, which is bloated, we're talking over $300 billion are in these bloated, long-only, long-duration, low-yield bond funds. Now, look, they've had a great run over the last couple of decades, but the reality is that run is over. And so if you don't have somebody who's thinking differently, like a Scott Colborn, or, we've talked about before, John, the private debt strategies we have at Sprott, which are producing tremendous yields with very low volatility. If you don't have different thinkers on your fixed income side, then you're probably looking at a world of hurt.
For listeners and advisors who would like to learn more about the Sprott strategies, could you give us your coordinates?
Definitely, John. I'm always reachable toll-free at 866-299-9906 or through our great website, sprott.com.
Thanks so much, and enjoy your week, and we'll talk again soon.
You bet, John.
After the break, we'll go to Catherine Murray of our affiliate BNN in conversation with Peter Costa, who is president at Empire Executions. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Our next guest says that the $1.8 billion U.S. takeover of Popeye's Louisiana Kitchen by Restaurant Brands International shows the company's appetite for acquisitions and demonstrates how much they know their audience. For more on this, let's head to the trading floor in New York. We've got Peter Costa standing by, president at Empire Executions. Peter, good to be with you today. Thanks so much for joining us.
Thanks for having me. I love being here.
Thank you. We love having you here. What's the reaction down on the floor there with respect to this acquisition? I guess it had been talked about, but what do you think?
Well, I think that there's a couple of things. That number one, this is a great acquisition for Restaurant Brands. Popeyes, they actually need the expertise that Restaurant Brands has at opening new restaurants, expanding markets and whatnot, and the capital behind it. So I think it's a good deal for them. But the other thing is, I think people are a little surprised because they're in the inquisitive, their acquisition mode, and Yum Brands, I think, would have been a much bigger play, but that would have been something that would have kind of fit. And I think that when they announced this deal, or they had been talking about it, I think that people are a little surprised that they didn't go after Yum Brands. But I guess the year is young, so you never know what's going to happen. But as far as what we think, it's a great move for them. Absolutely.
What's the reaction in the market with respect to the other restaurant companies? Obviously they're going to get bid up. Other restaurant companies or brands are going to get bid up with the potential of them being the next acquisition target. Which ones are on your radar screen for that?
Well, Yum Brands, obviously, like I said, would be one of them, but it's the biggest, so that's a tough swallow. But, there are Dave & Buster's. There's a lot of smaller ones that might be. I don't think that if you're going to look for, to do something like that, you want to make a splash. And I think the smaller companies they might need to get a bigger partner because, the market's moving past them. But I think that you will probably see the smaller ones merge, and I think Dave & Buster's and these smaller groups will end up merging just to have some sort of buying power. You have the ability. With 1,000 restaurants, you buy things cheaper than you do with 300. So I think you'll see that. Yeah,
but it's interesting, Peter, that you say you're surprised, or people there are surprised that it wasn't Yum Brands. I would think, though, that Yum Brands would be too big for them to acquire, and if anything, maybe this starts the race of acquisitions. Maybe Yum Brands goes down even more so the acquisition path to compete and stay up with the QSRs.
Yeah. No, it's possible, but also Restaurant Brands has 3G behind them. And I think that as far as, worrying about cash and putting together a deal like that, I think if it was right, I think that the people in Brazil would have no problem fronting the money, like they like to say. Yeah, I think that's a possibility. I think you're going to see something very big this year. I think this is a whole group that's almost been, the recession was there. They got destroyed, and there weren't any mergers. Now that the economy in the U.S. and Canada has gotten better over the last 7 years, these companies have done much better, and you still haven't seen that that takeover frenzy that you usually see when people are trying to get a leg up on a competitor. And I do think that this is actually that match that's going to light fire under someone's rear end, and I do think you're going to see more of them.
That's interesting, and the fact that you say you think it's going to be a big deal. I'm just looking at Yum Brands, just to check. Market cap $24 billion, call it $25 billion. You actually think that there'd be an appetite for that kind of size?
I think that it's possible. I think that if you want to make a statement and you want to bring your expertise to a much broader scope, that's where you go. I mean, they have 45,000 restaurants, so it's not like, they're a small business. It's a huge business. I mean, maybe it goes the other way too. Who knows? But I think that, you look at Restaurant Brands and how they've handled themselves and how well they've managed their acquisitions. I think it's one of the best Canadian companies out there by far, and I've always felt that way. And the funny thing is, I love Tim Hortons, and they only have one Tim Hortons in New York, and it's like you can't get those donuts in New York. Imagine that, the biggest donut market in the world. It's horrible.
Is it really New York City with everything there?
Oh my God, people. They love donuts. Are you kidding me? A Tim Hortons donut with good coffee? Oh, man, that's like heaven.
Right. I understand. I've had many early mornings on trading desks. Let me ask though, what's this indicative of as it relates to 3G's view, Restaurant Brands' view of the American consumer? I mean, you have to believe that they think that they're in the right timing and the right positioning to go in with this kind of deal.
Oh, absolutely. And you know what? I mean, I love Popeyes. So, I'm not a Chick-fil-A guy and I'm not a, KFC guy. I'm a Popeyes guy. I absolutely love their product. And I think if you put that out there and let people really understand how good it is, I mean, when you get, I know this is stupid and I hate to, bore people, but when you get one of their white meat breasts, it's like, it's the biggest piece of meat you'll ever get from any restaurant, any fast food restaurant, anywhere, and it's very well priced, and it's delicious, and they do a really, really good job. So I think that them going into that, I thought it was a lot of money, but you know what? They can expand their brand in Canada, U.S. They can expand their brand in a lot of different places, and it'll do very, very well.
Let's round out the picture here a little bit, Peter. You and I haven't spoken for a couple of weeks. What's your view of the market right now? We continue to see, I think, broad-based strength, some real leadership of some big bellwethers. Those retail numbers came out better than expected for Walmart and Home Depot. Some of the economic data points not as strong. Where do you stand right now in the markets?
Well, I'm still in the same position. I think that the market is overpriced. It's gotten ahead of itself. Although, seeing Walmart come out with better numbers than Home Depot, that's a good sign. That's a good sign for the U.S. economy and for Canada as well. And I think that that's actually a very, very solid piece of data this morning that we got. And I think that the market reacted off of that. You look at the financials and you still think that they're probably the leaders and they've been doing extremely well. I think what we'll end up seeing is, they're going to do well for a good portion of the year because I think rates are going up and I think that they're well positioned to take advantage of that. Not saying that that's the greatest idea in the world, but it is definitely going to help the financials. But having the numbers this morning from Home Depot and Walmart, that's a whole sector that, everyone's been looking at retail and saying, it's dead. People are getting killed. Amazon's killing everybody. But you know what? People are still going into the stores and buying stuff. So, I think that I think it's a good sign. And I'm still a little bit bearish because I just think the market's overpriced. But that gives me a little pause this morning. It really did.
What do you want to be overweight in this market?
I got to say that I want to go back into healthcare, even though
Really?
I think they're very highly priced. But I think that with the turmoil about Obamacare, repealing portions of it, they're not repealing it to help the consumer. Let's be honest. They're repealing it to help the insurers. I mean, I know that's a very cynical approach, but as an investor, you look at it and say, you know what, there's a lot of positives coming from that. The negatives it's probably going to trickle down, and it's not going to be the best thing for the consumer. But as far as the insurance companies, they want the insurance companies to be involved in some sort of health care, overall, and they want to make it profitable. Whereas Obamacare didn't really give, they could be profitable, but it wasn't nearly as much. I think they're going to try to do that. And to me, you know what, you get a health care company that is being helped by the federal government to be profitable, there's no limit to what they can do.
Last question. What about the banks and or the investment banks?
You know what? I think that the banks still have a little bit more room on the upside. I'm not saying that they're, you look at JP Morgan, it's trading $90 a share. Do I think it's going to 180? No, but I do think that this thing will touch $100. And there's still some room on the upside for these companies. They're printing money. You know, I mean, that's what they do, and they're going to give the opportunity in March. I would think in March to print more money. So you know what? And if they're starting to lend, which I do think that they are doing, which for the last 5 years I didn't think they were, but I'm seeing things where they are lending again, which is also a profit center, and that's also a good sign for the U.S. economy. So,
okay, we got to leave it there, Peter. Great to see you as always. Thank you.
Thank you.
We'll go to the news, and when we come back, Ralph Silva, independent analyst, Silva Research Network, who looks ahead to Canadian bank earnings. Stay with us, folks. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Canada's large banks kick off earnings season later this week. Most Canadian investors, of course, hold at least one of these banks directly or indirectly through mutual funds or ETFs. To talk about what we can expect, we're joined by Ralph Silva. He's an independent analyst at Silva Research Network, and he joins us right here in studio. Good to see you again, Ralph.
Great to be here. Thanks.
These earnings seasons give us pretty comprehensive windows into the earnings power of these banks. Often the view of investors is reset after earnings season is over as to whether banks are fully valued or not. What will you be looking for in this set of earnings?
Well, to be honest with you, I think the banks are going to do relatively well, simply because the economy in Alberta has actually recovered. Interest rates are getting better. Oil prices have recovered. Everything you can think of has actually improved the bank's perspective. So on retail banking and business banking, I think they're going to do relatively well. What I'm concerned a little bit about is the capital markets, because we just don't know. We know that people, after the Trump election, looked at their portfolios. We don't know if they actually change their portfolios. We just know that they analyze them. We don't know if they change them. So we're going to look at that. But overall, the banks, the Canadian banks, are going to do what they always do: moderate growth, solid growth, and they're good investments.
Alex, your view?
Yeah, I mean, I would agree with that. I think capital markets are going to be a little better maybe than expected there, just given markets, and I think that they were positioned for upside there. So I think the trading volumes will be pretty good, and I think that the commissions will be pretty good. Deal flow was solid, so I think we're going to see some upside there. And I agree. We're going to see a fairly benign credit environment. We're probably going to see dividend increases out of Bank of Nova Scotia, TD, and Royal. So still moving along as great dividend growers over time. But valuations is my concern. Valuations are at the very high end of historical, and I think they really have to deliver a lot in order to get further upside after a 50% run over the last 12 months on average for the banks if you include the dividends.
Do you share that concern on valuation?
I do, but I think that a lot of the valuations have already been put in. I think that we have some turmoil coming up because the banks are doing well, but there are some risks involved. The first risk is, what is Trump going to do? Some of our banks have up to 30% of their revenue coming from the U.S. We don't know what the rules are going to be. He said he's going to remove some of the rules, but which ones? And there's a huge cost in removing rules, regulations. So there's that element. And then there's a European element, because Canadian banks are heavily into Europe. They're mostly in the UK. Is that going to change there? So there are some risks coming up. But overall, the Canadian market seems to be the solid market, and where we're seeing a lot of investment coming in from around the world. It seems to be safe, at least until we get the French election in April. Then we'll get probably more consensus as to what to invest in Europe, and we may see some money leave. But until that point, I think we're going to do relatively well.
On regulations in the U.S., that, of course, has been interpreted by the market and many investors as a positive for the banks. And we've seen the U.S. bank stocks rally significantly on at least partly that thesis, that Trump will ease regulations. You don't think that's a positive for Canadian banks operating in the U.S.?
I think it's a problem if you're in a U.S. bank, if you're sitting in Manhattan, aren't you spending millions of dollars lobbying the Trump administration to put in rules that make it harder for foreign banks? You have to assume that's happening. But let's be very clear here. Every analyst you talk to has some kind of perspective of what's going to happen in terms of rule changes. Let's be clear. Nobody knows. We just don't know. So the banks, the Canadian banks and the global banks, are doing the right thing here, because what they're doing is they're cocooning their operations. Let's operate. Let's not make huge investments. Let's not put new people on. Let's not hire new people on. And the Canadian banks are doing the same thing. And that's a positive thing to do right now until we have more clarity.
Alex, it's TD Bank, Bank of Montreal, and Royal that are most active in the United States. Is that a key differentiator for you when you look at those banks?
I think it's a positive because they get a benefit from the acceleration of the U.S. economy and all the good things going on there. I slightly disagree on the impact of deregulation because these, for all intents and purposes, look like U.S. entities within the United States. I mean, Royal Bank, for example, bought City National, which was a long-standing and well-respected U.S. institution, and it still has that face on, both from a regulatory standpoint and from any other standpoint you want to look at. Lower taxation is another thing we didn't touch on, which for U.S. subsidiaries of Canadian banks, this is a positive. BMO, a great example of the heartland of the United States, where Trump's voters were congregated in the Midwest, the big manufacturing districts. They have a big commercial lending business. It would be interesting to see if there's any sign of acceleration or rising confidence there. I think that's something to watch for BMO.
What will you be watching in the U.S. banking results of the banks?
For not just the U.S., but all of them, the same type of thing. We need them to be more effective and more efficient in terms of transaction costs. We need some operational changes within all the banks. I'm looking for banks, and I'm not proud to say this, but I'm looking for banks that are laying off people. I need all the banks to get smaller. They need to invest in technology. They need to go all digital. The banks that are ahead of the game in that are probably European banks. I want to see the Canadian banks invest more in technology. And sadly, and I don't say this with pride, but they need to lose people. They're just too heavy.
The Canadian banks, almost all of them, certainly say that they are advancing their digital strategies. Are they compared to banks around the world?
They are advancing. Are they advancing as quickly as other banks? Absolutely not. You look at the HSBCs of the world, the BNP Paribas, those types of organizations, the advancements that they've made are extreme. Yes, Canadian banks are more conservative, so it's going to take longer, but I'd like to see more investment in the technology area so that they become much more effective, and I think that has to happen relatively soon.
Ralph, thanks a great deal.
Thank you.
Ralph Silva is an independent analyst at Silva Research Network.
Now to Rob Lister, founder of RateSpy.com.
Welcome back to House Money. Well, we're not far off from entering the spring selling season in Canadian housing. And with the Fed south of the border sounding more hawkish on rates, we wondered what the impact could be on mortgage rates right here in Canada. So for Insight, I spoke earlier with Rob McLister. He's the founder of RateSpy.com, and I asked him about the all-important, unpredictable Trump effect.
We know that he's going to try and invigorate the U.S. economy. We don't know how that's going to play out here in Canada because his tax cuts and his deregulation and all that good stuff are going to increase demand for Canadian goods, other things equal. But at the same time, the tax policy and the trade policy and all this other stuff could be bearish for rates. So we kind of have to wait and see what gets passed through Congress to figure out how he's going to impact mortgage rates.
I guess on one side of it, if his policies are expansionary and he starts driving the bond market yields higher, then we get dragged along with that. But if his policies somehow smack the Canadian economy, we could be on the other end of the spectrum with the Bank of Canada even pondering a rate cut. They haven't ruled one out recently.
Yeah, so it's not just the Trump question that is going to impact rates going forward. So another big wild card is oil. Oil falls out of bed into the $20s and $30 a barrel range. Then we're going to see significant downward pressure on rates, other things equal. So keep an eye on the 5-year bond yield. Right now we're kind of holding steady, and the 5-year yield leads fixed mortgage rates in Canada. Long term, it follows U.S. rates like a pair of train tracks. But right now, there's a very distinct possibility that if something happens with the U.S. trade policy or whatnot, or the competitiveness of the tax regime down there versus Canada, we could see those two U.S. and Canadian rates diverge.
Really? So we get out of that contractual, I won't say contractual, but that situation we've been in before where we're sort of tied to it. You can actually see that breaking down, that correlation.
Absolutely. I think at least for, the medium term, and that could be a year, could be 2 years, 3 years. Again, you see, oil just dip into the 20s and 30s. That impacts business investment in Canada. It's a huge contributor to our GDP. And so unless we have something to replace it, then, that is definitely going to weigh on rates. And now we're seeing these mortgage rules take effect. And the big question mark is how that's going to impact housing demand. Again, another material question mark for rates.
What have you seen in your business so far? Because it was last fall that we saw the new mortgage regulations come into place. A lot of people warned they'd see a huge drop-off in their business. How is the mortgage market setting up in 2017 with these new rules in place?
it's going to be a softer 2017 in the mortgage market. So, the Bank of Canada came out and said that in the GTA and the GVA, that 40% of insured borrowers would no longer qualify under today's rules. So that's a material amount of demand that you're removing from the market. Now, there's other things that are supporting the market as well. In Toronto, we have a big shortage of listings, and that's, keeping prices inflated. But yeah, it's going to be a slower mortgage market. I'm talking to non-bank lenders that are down 20, 30 or more % year over year on their mortgage business.
And this is even with Toronto. We know that Vancouver's rolled over in a big way, but Toronto continues to roar higher. But even the softness there?
Oh, absolutely. Yeah. Nationwide. Most lenders are nationwide lenders with the exception of credit unions and whatnot. So, things are still smoking in Toronto for the most part, albeit lenders are getting a little bit more concerned about valuations. So they're, you're seeing appraisals come in a little bit less in some cases than you might expect. But overall, on a nationwide basis, we're going to see, I think, a material drop in mortgage originations this year.
Now, in terms of the kind of mortgage people should be shopping for, we talked about all the different variables that could affect bond yields and the fixed mortgage rates, or central bank policy, of course, the floating rates. Right now, what does it pay to be in? People are always asking me that question. Should I be in a fixed or should I be in a floating?
Yeah, you know what? It never pays to be a rate predictor. Ever, because you can't do it. You got billion-dollar bond traders that can't consistently predict interest rates longer than the very short term. So any consumer that thinks they know where rates are going is slightly delusional. I'd say really delusional, but I'm trying to be polite. The fact is that the step number one is to figure out your risk profile, right? What kind of savings do you have? How much home equity do you have? Is your employment stable? That kind of thing. And then measure what kind of hit your budget would take if rates went up 1 or 2 percentage points. So that's step number one. Now, if you're in a good place financially, then you can take more risk, because I don't think any economic model out there is projecting a significant increase in mortgage rates. So, you can take a little bit more risk in a variable. Long-term variables have paid off compared to 5-year fixed rates. But if a 2 percentage point increase in rates would hurt you when your mortgage renews, then you got to look at a 5-year fix. And there's some great deals in 5-year fixed today.
Now, we're coming to the end of February. It's premature maybe to talk about the spring market, but it'll show up faster than we think. Every spring, we usually see the banks go to war with each other on rates. Given the climate that we're in right now and the tightening we've seen from Ottawa, do you think we're going to see a rate war this spring?
I don't think so. It's been so quiet in the rate promotion front. Really the only exciting thing happening in the mortgage market right now is HSBC's 2.35% 5-year fixed rate. And, that is a tremendous rate. It's the rate of the year so far. No one else is even close on a refinance for the 5-year fixed. So apart from that, we've seen nothing. We've seen BMO come out with like $1,000 cash back, but mathematically that deal doesn't really make a whole lot of sense. So what will we see come spring? I think that let's see where first quarter results are for the banks and the mortgage originations. I think if you start seeing another month of slow sales and slow mortgage volumes, you could see a couple rate promotions out there, but nothing too exciting, I don't think.
We'll go to the final break, and when we come back, Thomas Zitsouras, Vice President and Head of Fixed Income Research, Stratigas, who joins our affiliate BNN to break down the February Federal Reserve minutes. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Welcome back. Well, markets and investors definitely looking for some signs from the U.S. Federal Reserve as to how many times they might be raising rates this year and when. For more on this, we're joined by Strategas' Head of Fixed Income Research, Tom Zitsouras. Tom, good to be with you today. Thanks so much for joining us.
No, my pleasure. Thank you.
I want to show our viewers the reaction in the market, and I think that probably one way to look at that and how the market's interpreting the Fed is to take a look at the U.S. dollar, which did show some decline following the Fed. So it sounds as though the minutes are somewhat on the dovish side, quite a bit of a decline actually following that 2 o'clock release. So let me give you a few more data points that we learned from the Fed. As I mentioned at the top of the show, many Fed voters saw only modest risk of significant inflation. They also say that they saw a hike fairly soon if the economy is on track. But they also talk about the unemployment rate as well, and there's still somewhat of a debate in terms of when it will be. How are you interpreting these comments? People were thinking that they were going to tell us something that would get us prepared for a March hike. That was kind of what was talked about, I think.
Yeah, and my initial read is actually this is a little bit more hawkish than the statement that was released earlier in the month. I think the problem is, I shouldn't say problem, but the issue is that the consensus coming into the Fed minutes was that this was going to be the case. This was going to be a more hawkish statement, more hawkish minutes. And so I think there was some prepositioning ahead of that. And I mean, we can look at the actual language here, and what we find is what they're really saying is what we really knew ahead of time. March is live, but the hurdle is high for a March tightening.
Okay, so in other words, what we're seeing in the market and the U.S. dollar, which the U.S. dollar strength or lack thereof right now, is really because people had thought that it was going to be hawkish, so maybe just pulling back a little bit of that money. But your interpretation is expectations for a little bit of a hawkish statement or hawkish minutes, and we did in fact get that.
Yeah, exactly. I think we met those expectations, and that was the consensus coming in, and now we're getting a little bit of activity on we kind of sell on the news, as you're seeing.
So selling on the news, what does this really mean then in terms of what we're learning today and whether or not, in your opinion, the economy is strong enough for a March rate hike?
Yeah, I think what it's telling us is really that the economy, as the Fed sees it right now, is still not yet in the position they'd like it to be in. And so as a consequence, they don't see an immediate need to raise rates in March. But what it tells us is they are very much looking for maybe 2 or 3 data points that would tell them that a next hike is a go. And their probably central tendency is still probably somewhere around May, and the market's pricing in somewhere between May and June, so basically a May or June hike. But it's telling us that these minutes are telling us that they're still not ready to go in March.
What do you think is going to be the key metric that they're looking at? I mean, we know, we've talked about this for years now in terms of their mandate and what they are to look at, but what do you think it's actually going to be?
If there were any one data point, I always like to point to average hourly earnings, that is wages, because wages are still going to lead inflation. But if you were to see some combination of a further improvement in wages and inflation, I think that would probably get the Fed off the sidelines for March, certainly for May. But for example, I don't want to throw out a number here, but anything above maybe 3.1% in average hourly earnings for the February report that comes out next week, that would be an eye-opener for the Fed.
Tom, what does this lead you to do as it relates to recommendations for your client base?
Well, I think this tells us that the Fed still wants to be aggressive this year. They still want to go 3 times. That seems to be their base case. Maybe a potential for a 4th, but 3 seems to be the central tendency. And what that means is that the U.S. yield curve is probably going to be more inclined to be flattening. That is, the back end of the curve coming down relative to the front end of the curve. So it probably means that you want to be positioned in slightly intermediate maturity durations and still in pretty good quality credit, but not too high quality. So you want to be, we'll call it middle tier credits in the intermediate portion of the curve. There's really no reason to be taking risk off the table, either in corporate bonds or in equities at this point in time, because the Fed is still telling us they're going to be very supportive, at least for the next quarter.
How do you think fiscal policy from President Trump plays into the Fed's thinking right now?
I think it plays in the sense that they don't know what it's going to be, and they really desperately want to have a better idea as to what fiscal policy is going to look like. And unfortunately, they're in the same position that the rest of us are in. They know that if and when fiscal policy stimulus does come, it's probably not going to hit until the second half or even of this year or early next year, and so it's very hard to plan for that. And then on top of that, there has been some political capital that's been lost by the Trump administration of late, and that puts some of these reform programs in jeopardy. So the Fed is basically in the same position many of us are in. They want to believe that there's going to be something coming, but they just don't know what it is or when it's going to hit.
Tom, there's a few other points that I think are interesting, because I wonder if it isn't a little bit more dovish than we're talking about in terms of these minutes. One of the points is that some officials saw downside risks from some potential policies. That's number one. Fed officials thought some time needed for the outlook to clear. Number two, in other words, they really want to give this time in terms of President Trump and the fiscal policies. And then some Fed officials saw downside risks from the dollar strength. All that, to me, sounds even more dovish than the expectations in the market moving into this.
Yeah. I think what we're looking at here is a traditional two-handed economist here. They're saying on the one hand, things look good. On the other hand, things don't look so good. On the things that don't look so good or the risks to the downside, one, the Trump administration's potential for a trade protection policy has got to be something that the Fed is keeping an eye on as a downside risk. And again, we really don't know how that's going to evolve. There are some very worst case scenarios that could happen, but are probably not likely. But still, that's a big concern. And another one is if they were to be more aggressive, particularly more aggressive tightening, the Fed is, than the bond market has priced in, then the dollar is going to rise from that. And that's going to put an immediate drag on both U.S. growth and inflation. And so the Fed has to be concerned about that as well. So I think that's another reason why the Fed wants to let the market know March is live, but really they're not really inclined to move in March. That's not their intent to move in March.
Tom, last question, just from an investment perspective. We, of course, have a lot of viewers who own fixed income products, and many people a couple years ago were talking about the great rotation out of fixed income. And maybe we certainly did see some of that last year. But the big question is what's next? And the way you describe a higher yield environment for the short end of the curve, the back end flattening out a little bit, are you essentially suggesting that we're going to see this lower for longer interest rate curve environment?
At least on the back end, it's going to be very hard for long bond yields to normalize, or whatever your definition of normal yield is. I really don't see a great rotation out of long duration bonds happening, at least in the next 12 months. You have to have much higher growth and inflation expectations for that to happen than we see right now. So you could see some migration out of the front end of the curve and the belly of the curve inside of 3 years, absolutely. But between 3 and 10 years and 10 years and beyond, that's still pretty sticky right now. That doesn't mean yields can't rise. It just means we're not likely to see a normalization, say 10-year yield of 4% anytime soon.
Okay, we'll leave it on that note. Tom, always good to speak with you. Thank you.
Well, folks, that's it for Money Talk. Thank you so much for joining us this afternoon. Hope you have a good week. We'll be back next Sunday at 2 p.m. I'm John Budden, and you